A very good afternoon to everyone. I'm Timing.
I'm Cyrus.
Welcome to the panel on T-bills, or at least it was supposed to be a panel until we got abandoned by our moderator. Just kidding, he unfortunately got assigned a same speaking slot at this timing, so he couldn't join us for today. But fret not, the content will be still as exciting. Don't worry, the content will be mostly quite lighthearted. It won't be as relatively heavy as what you have heard just now. So do keep through and it will be quite simple lah. Let's just jump straight in, shall we? So let me begin by asking, how did the fixed income market perform in 2023?
Yeah, so maybe I'll start off on this. So I think if there was one word to summarize how fixed income did in 2023, it was that they did good. So I think 2 years ago, if we look back to 2022, you might remember that 2022 was not so good a year for fixed income. But last year, 2023, was a bit of a redemption year, a bit of a year of rebounds for fixed income. So across your different segments, like your global IG up over 5%, Asia IG up over 7%, global high yield up over 14%, and even both short and long duration, both at the end of the year, they closed at about 5-6%. So I think in general, if you had a diversified portfolio of fixed income securities of different bonds, I think generally speaking, you have done, as I said at the start, pretty good in 2023.
So for those who are familiar, we are still in an era of an inverted yield curve. Both the yields on the US Treasury and the Singapore Government Securities remain relatively inverted, with the shorter tenor treasuries and also sovereign bonds offering much better yields than those of the longer tenor ones. So a few months back, we did get excited for a while, with the 10-year US Treasury reaching 5% for those who have actually seen it. The past few months were a period, we thought that the yield curve steepening will be coming, and yet it didn't. So the past few months was a period of time, right, that we have seen the greatest fluctuations in 2023 itself. So what was the consequences? We end up seeing very volatile mark-to-market changes in the bond prices, and this is in Sing dollar bonds as well. This is something that we have seen. While the end of the year still marked a positive returns for all bonds, Sing dollar included, I don't think it will be unfair for us to say that it has been a pretty rough year for the entire bond market itself. So with the fixed income space being relatively volatile last year, I think we have been able to see a relatively large change in relatively large movements of funds across the various opportunities last year. So where have the investors been placing their monies in 2023? Of course, other than T-bills itself. So a couple of comparable items, first being fixed deposits. So in 2023 itself, we did see very limited growth in the fixed deposit rates. I think this is something that everyone has felt. Generally, it didn't come across as too surprising for us. First being for the fact that across the banks itself, we are already seeing a limited slowdown in the demand for the growth in loans. And at the same time, most of the banks have already seen more than sufficient funding at the current moment. So we have looked at the 3 Singapore banks, DBS, UOB, and also OCBC. The growth of the time deposits was actually significantly slower in 2023 as compared to 2022 when we saw the initial rate hikes. On the other hand, T-bills continue to be very attractive in 2023 itself. So of course, the T-bills, both T-bills, 6 months and 1 year, we didn't see the exciting 4.4% peak of cut-off yield that we saw in late 2022. But nonetheless, the demand for T-bills was still quite attractive in 2023.
Yeah, so I guess for me, in terms of where investors have been parking their monies, I think for me, what I've been seeing is quite a lot of flows into cash-like products. And to me, we have actually seen this sort of flows actually increasing even from 2022. And this, I think the main reason for this is that all our clients, including myself, now we want to, park our money while earning high yields. And, 2 years ago, you might think, well, it's a bit tough of us, right? You want somewhere safe and you want to earn high yields at the same time. But actually, I mean, with the current interest rate environment, I'll say it's never been easier to find somewhere safe to park your money while earning pretty decent yields as well. I guess, and just now Timing mentioned fixed deposits, T-bills. I think most of us are very familiar with those 2 products. I'll just add on that there are also other products out there that give you an indirect exposure to these fixed deposits and T-bills. So for example, a lot of your money market funds, they invest perhaps in T-bills specifically, so it's an indirect investment. There are also some money market funds that invest directly into bank deposits as well. So apart from the direct investments, there's also the indirect investments, and it really is really another option for you investors to consider if you want to earn money in a relatively risk-free manner while earning a pretty decent yield. And I mean, just to end off, 2023, good for parking your money, earning high yields. But what about 2024? Well, what we think is that, with inflation remaining sticky, with the prospect of rate cuts looking quite unlikely in 2024, we think that these, attractive rates that you are getting from your T-bills and so on, they are going to stay in 2024. And you should not overlook them for other investment alternatives. If you are looking for something relatively risk-free, earning decent yields, we think that T-bills will continue to be attractive in 2024.
So, of course, on this particular topic of Singapore government, let us go with the more easier one first. So, how attractive has the Singapore government bonds been in 2024? So, based on historical data for the previous 2 rate cycles, right, we have been seeing the yields on the Singapore Government Securities, the SGS, it tends to stagnate or fall off gradually during the rate pause period. So for this itself, I think it's rather reasonable for us to actually expect that the yields on the SGS will start to taper off slowly in 2024, especially for the longer tenor issuances. So for investors looking to lock in yields on these AAA credit rating issuances by the Singapore government, early 2024 might be a good timing to consider.
Well, maybe I'll add on. So early 2024 is a good time, and obviously if we look at the SGD bonds, again, past the previous rate hike cycles, I think the trend is very clear that they do taper off very quickly. But I think apart from yields, one other thing I want to add and remind investors is on credit quality. So as you might know, Singapore government bonds AAA rated, and this is not a common rating. So this is reserved for, I would say, the safest of the safe issuers out there. So for example, even your US is not AAA anymore. Even your European Union is also not AAA. AAA issuers are, apart from Singapore, your countries like Germany, Australia, Canada, and so on. And these are really, again, the safest of the safe issuers out there. So I guess to answer this question, how attractive will Singapore government bonds be? I think to me, the crux of the answer is that what is your investment profile? So if you're a conservative investor, you don't want to take too much risk, you want to preserve your capital, yes, Singapore governments will be extremely attractive for you. They, again, very safe, offering very attractive yields right now, 3+% on your T-bills, for instance. If you are a bit more aggressive, you want to take more risk, then we think that, yes, Singapore government bonds will still be attractive, but perhaps you could add in a bit of some perhaps more risky corporate bonds as well to have a more diversified portfolio between your very safe government bonds and perhaps something riskier as well. Because again, these are offering pretty attractive yields right now.
So coming to the highlight for today on the Singapore T-bills itself. So across 2023, we have seen the yields largely remain between the range of 3.7% to 3.9%, even though we did see the Federal Reserve having the rate hikes in the earlier half of 2023. So in 2024, we mostly expect the yields to remain range-bound, especially on the backdrop of a higher for longer interest rates environment. We are currently expecting, we are more inclined towards expecting the Federal Reserve to hold rates for an extended period of time, which this should ultimately allow the rate pause, to provide support for the yields on the T-bills at the current moment. Of course, you might be thinking, in the current market conditions, we have so many options out there. We are spoiled for choices, fixed deposits, Singapore savings bonds, etc. Why would you be wanting to invest in T-bills? I think there are several good reasons for you to actually think about. Firstly, the yields are guaranteed as compared to, for example, money market funds, although in exchange you are sacrificing the liquidity since that T-bills can only be sold and exchanged on the secondary market. Secondly, of course, comparing against fixed deposits, I think the reason should be quite clear. So fixed deposits now, if you do look at it, it can be quite hard to find similar yields or yields of what the T-bills can offer without other underlying conditions. For example, having to lock in your monies for a couple of years. At the same time, with the SGS yield still relatively inverted, it remains one of the best timing now to actually invest into T-bills. Yields on the longer tenor SGS remains quite inadequate in terms of compensating investors for the duration risk of the longer tenor issuances. So what this, from a portfolio perspective, short duration bonds should remain a key part of your portfolio towards mitigating risk. especially clearly since that T-bills will be one of the best options that now they can offer. So why take on additional risks when you have risk-free rates offering around 3.7 to about 3.8%? At the same time, talking about the short duration and also short the tenor itself, T-bills will actually allow you to continue to have the opportunity to pivot into other places should the time arise. So imagine you are looking at other places and you know that the time is right? The money will be quite liquid for you in terms of the short duration as compared to having to be locked in over an extended period of time like what fixed D does.
Yeah, absolutely. I think the points about the T-bills being much more liquid than fixed deposits, in terms of sometimes fixed deposits, you're stuck there for maybe 1-2 years. I think that's something that you definitely should not overlook when considering all your different options out in the market. But perhaps playing devil's advocate a bit, I also want to note that T-bills, sometimes in terms of the actual liquidity, if you need to absolutely sell, let's say tomorrow, then the liquidity may not be that amazing if you need to sell like within 1 day. You might need to wait a few days, for instance, to get a good price. So I think it really depends on how much liquidity you need. If you foresee yourself, for example, needing money extremely urgently, you don't know when it's going to come, but there's going to be a time where you need to withdraw it within 1 day, then perhaps your money market funds might be better. But again, it's the compromise between your liquidity and your guaranteed use. Again, your T-bills, they come with guaranteed yields. When you buy the bond, you know what yields you're going to get. And we think that I think for most investors, including myself, we think that we don't need that immediate liquidity. We don't need to withdraw the money within 1 day. And then T-bills will become your premier option, again, for the guaranteed yield. Once you buy, you know what you're getting, and you know that what you're getting is a pretty good risk-free alternative.
Yep. Of course, coming to the end. So for those who find themselves stuck in between being able to slightly afford more risk, but you're not at the extent of equities, right? This part is for you. So what about the SGD corporate bonds? So SGD bond issuances have been at the lowest over the past 3 years since 2021, which this ultimately shouldn't be that surprising as well, given the high interest rates environment that we are seeing now. We expect conditions to become a lot more favorable in 2024 for them to issue debt for 2 reasons. Firstly, ultimately, we are expecting yields to become quite stable in 2024 with much lesser volatility as comparing to 2023. This should allow an easier time for issuers to actually assess the markets whether they want to issue debt. Secondly, at the end of last year, we started seeing new issuances pricing in below expectations. So what happens is we believe that this is due to a pent-up demand for SGD bonds, which ultimately this should help with further issuances in 2024. At the same time, we advocate a need to focus on quality investment-grade high-yield issuers likely will see further deterioration in credit profile in 2024, given the continued high interest rate environment we are seeing right now, while at the same time, quality issuers will be able to bear this impact better.
Yeah, definitely. I think the word quality is extremely important. And then the question is, what is quality, right? So I think the most important part in looking at individual bonds is to look at the issuer and determine, are these good issuers? And actually, throughout 2023, we have given quite a number of recommendations within the Sing dollar space for corporate bonds. So I'll just give a few examples. For example, earlier this year, we recommended some Sing dollar bonds from Shangri-La. So that's obviously a hotel chain. I think everyone here has heard of Shangri-La. We have also recommended bonds by conglomerates like Straits Trading. We have recommended, for example, property names like Metro, the departmental store? Yeah, that Metro. So we have actually garnered quite a bit of recommendations throughout the year within the SGD space. And I think the common thread between all these recommendations is quality. We have looked into all of these bonds. We have thought about, are these good issuers? Are these going to remain solvent? Are they liquid? And we think that these SGD corporate bonds could be very good alternatives to T-bills. They are slightly higher risk than T-bills. They are not the risk-free nature of your Singapore government, but they do come with higher yields as well. And again, if you are looking for that extra bit of yield for a little bit of risk as well, we think there are loads of options in the SGD space that you can consider in your portfolio.
So one area that we really liked in 2023 was the bank bonds, and we believe that it's likely the bank bonds will likely remain attractive in 2024 itself. So what happened for most banks, right? They actually saw very good profitability in 2022 and 2023. And although we are starting to see some headwinds in 2024 itself, the overall profitability is likely going to be better than the pre-rate hikes in 2021 and before. At the same time, the profits has actually allowed most banks, right, to further build up their capital buffers. So that's another decrease in the credit risk for such banks. Senior bonds will ultimately be preferred, ultimately given for the fact that they have a higher seniority and of course a lower risk to undertake. But for tier 2 subordinated bonds, right, this will be appealing for investors who are able to take on additional risk for some additional yield pickup.
Yeah, so I think lots of recommendations. Just now I talked about some property names, Tea-Ming talked about some bank names. I think we release our recommendations quite frequently, and you can really check it out on any of our iFAST platform, including Bond Supermart, for instance, BOND Supermart. So I think that's really, we try to publish our weekly recommendations, and we have lots of recommendations that we really like to share with you. But I guess in the spirit of time, I'll just leave you with the Bond Supermart platform that you can really consider if you are looking for regular recommendations on very different bonds with different risk levels, with different tenors, and so on and so forth.
Right, so today is just a brief preview. We are upcoming, we'll have a webinar on the 17th of January. For more information with regards to this webinar, please refer to our Bond Supermart website, or you can simply search out Telegram Bond Supermart for more information on this webinar itself. Once again, I'm Tea-Ming.
I'm Cyrus.
We thank you for joining us today, and we look forward to seeing you on the webinar. Thank you.